Hello and welcome back to another episode of AdvocHats. Today you're joined by me. I'm joined by Dhananath and I'm Akhila Randeniya and I'll be the host for today's show. So let's talk about the elephant in the room, Dhananath. Domestic debt optimization or DDR, as some folk like to call it, has been a point of contention for quite some time, if I'm not mistaken. Initially, with the entire IMF situation and the IMF coming down, a lot of people were kind of worried about how our debt would be organized or restructured, and as to what the implications would be to both local markets and the foreign creditors as well. So I think if everyone has been paying attention, just to give you catch up everybody as to what's been going on, the government has been engaging in its presentation of domestic restructuring of domestic debt and has taken essentially a long weekend. So today and tomorrow are both declared bank holidays, if I'm not mistaken, in order to better understand and to figure out where we can land as a country and as our financial system as a whole to ensure stability going forward. Um, and I believe there were three situations or three scenarios that were presented by the central bank. And Danath, would you be willing to take us through them?
Thanks, Akhila. I think ideally the governor should, I think governor briefed some of the things, but we are just trying to understand the implications because I think there's also confusion among people what is happening and what is impacting this for my bank deposits, my fixed deposits, and my EPF, ETF. So we are just trying to uh, evaluate what has been presented. So the basic outline is there have been three main restructurings indications have been given. Just to provide clarity, Akila, in Sri Lanka's debt, there are two sides. One is called the external debt. That means that the government of Sri Lanka, our own elected government, over the years have borrowed money in dollar terms, but these dollar terms are under foreign law, basically the New York law or the London law, which is called the sovereign bonds. But in that external debt category, there are sovereign bonds, there are bilateral creditors where we borrow from countries like China, India, France, everyone. And of course, there are borrowings uh, from multilateral agencies. So that's we completely kept aside. We don't know yet what is the restructuring plan for that. Then comes the local debt, which is are two components mainly. One is some debt the government has borrowed in Sri Lankan rupees under Sri Lankan law. So that is there are two sides for that: treasury bills and treasury bonds. Treasury bills are mainly the short-term debt you call the government securities, debt instruments less than 1 year. And then we have the treasury bonds. I think treasury bonds became very popular with the bond scam, which was in 2015-16. Everyone got to know what a treasury bond is. But additionally to these two, there is another Sri Lankan debt component or like a local debt component, which called the Sri Lanka development bonds, which is issued under local law but in dollar denominations. That means if people like Akila or me have dollars by any chance, which we don't, we can buy that bonds which is under the Sri Lankan law, but the government promises us to pay a dollar interest instead of a rupee interest.
Right.
So those are the three categories. So in this sector, I think the government is mainly looking at the treasury, the local debt. That is, local debt
Right.
is mainly the treasury bills, treasury bonds, and the Sri Lanka development bonds. And there's another category called a small amount called FCBUs. So those are the main three categories that they have considered. So under this treasury bills, the government had said except the treasury bills holding by the central bank, none of the other treasury bills will be restructured. So when I say treasury bills, now people might be also concerned. Now the central bank is going to restructure, and what do they mean by the treasury bills holding by the central bank? Because they are the ones who are doing the restructuring, and they are saying there are some treasury bills with us which we are going to restructure. So these treasury bills are mainly, Akila, the process is when the government needs money. Let's say the government wants to, just as an example, they want to build a building. or let's say a swimming pool at somewhere,
Okay.
and they don't have money. So basically, they say, okay, we are giving you a piece of paper, uh, and that piece of paper has mainly three things: the amount that we want, let's say 1 billion, and they say we will pay it in, we pay an interest rate of, let's say, 5%, and the payment date. So if it's less than a
Okay.
1 day or 1 year, it calls under treasury bills. So
Yeah.
what happens is the government says, okay, we are giving this piece of paper, we promise you to pay, you give us money. So basically, central bank run this operation. So when the central bank basically, if no one else is giving money, or if central bank think the money that has been quoted, the interest rate is very high, but the central bank this is they say, okay, we will buy it from the government. So they are basically running the operation, but they will also buy it from the
Yeah.
government. So for central bank to give money, they don't have any deposits. What they do is that's called the money printing. They
Yeah.
run the printing machine, just as an example. So they take the money and they give it to the government, and they keep the treasury bill. So after that 1 year maturity, basically central bank itself getting that 5% interest rate on their own printed money and keep it for to run the central bank
Right.
operation. So that's the treasury bills that they have said that they are going to restructure, which is under central bank.
Okay.
But they have said that will be restructured in phase two. So
Okay.
that's first component. The treasury bills under central bank will be restructured under phase two. Approximately, there are about 4 trillion overall treasury bills, and out of that, about
Okay.
60% is under central bank. So that's about
Right.
2 trillion to 2.5 trillion approximately of treasury bills, short-term ones with central bank. They said they are going to restructure it in the second phase, but they have given a guideline that 12.4% interest rate up to 2024 and 7.5 interest rate up to 2026 and 5% interest rate until maturity,
Yes.
some composition. Now the second one is the treasury bonds. So under treasury bonds is being held by two again main sides. One is the banks, that is commercial banks, and when I say commercial banks, all commercial banks, including the government banks, and the EPF and the ETF, or called the superannuation funds. So there they have kept completely the banking sector aside. They have said, okay, we are only going to restructure the bonds which is held by the superannuation funds, or in other words, EPF and the ETF. So about, I think, more than 80%, or I think approximately more than 90% of the assets of the EPF and the ETF, what they have done is they have bought the treasury bonds. Bought in the sense, when government wants money, they said, okay, look, we have this chunk of money which has been contributed by private sector employees every month. They have been deducting about 20% of their salary, basically 12% from the employer, 8% from the employee, and we have this huge chunk of money which is approximately about 2.5 trillion. And from that 2.5 trillion, of course, the members also get an interest rate every year, so they have to invest
Right.
that money. So they have, but they have said, when the government needs money, look, we have a pot of money, we will buy the treasury bonds from that money. So what the government had said was, they have given two options for those treasury bonds holding by the EPF. They have said one option is, we will pay 12% interest rate for those bonds till 2025. 12% interest rate we are paying. For the bonds afterwards, after after 2025, they will pay a minimum of 9% till the maturity.
Right. Okay.
That's what they have said, or else they have another choice. That is actually not a choice. They have said authorities may consider, that's the wording that they have used. They have said
Okay.
either we have to charge a 30% income tax for that fund, uh, for the money which is in that EPF fund. At the moment, it's
Okay.
14%. I think people get
Right.
confused. Does that mean that when I'm going to withdraw money from the EPF, whether I am getting 30% tax? No. This is the pot of money where we all have contributed. It's run as a separate fund. It is same like the bank. So we all go and deposit money at the bank, and the bank getting taxed at, let's say, 28%, that doesn't mean that I'm getting 28% tax when I'm withdrawing the money. It is like the bank,
Right.
when they run the profit, they get like a 28% tax. So here,
Right.
what they have said is not when the people are withdrawing the money. It is when for the fund, for the entire fund, uh, overall every year for their profits,
Right.
they will take an income tax as a
Okay.
revenue
Okay.
or income tax of 30%. Now it is at 14%. We are already paying a tax. Now it is at 30%. So that's the choice that was given to the superannuation fund. I think people always question whether just this maturity extension means whether I cannot withdraw money from the
Yeah.
EPF ETF. That is not true. Of course, you can withdraw money because for a year there's about approximately about 200 billion being collected by the contributions by the private sector,
Okay.
and only about 170 billion being people being taken out upon their
Okay.
retirement. So there's always a 30 billion surplus every
Right.
year from the contribution to the EPF fund and the withdrawals from the EPF, and their fund base is 2 trillion, so 2.5 trillion. That is
Right.
2,500 billion is their asset base, but every year only people are taking about 170 billion.
Right.
2,500 billion is the asset base, only 170 billion is the withdrawal. So that's the difference. But those 2.5 trillion is invested in different assets, mainly including treasury bonds. So I think that's the confusion and the clarity that we want to, I
Right.
mean, that's the
Yes.
case. Sorry, my answer is quite long, but just
No,
wanted
that's
to
completely fine.
keep everyone. I mean, as far as I understand, maybe happy to comment on if anyone has different opinions. The For the SLDBs, that the Sri Lanka development bonds, which I mentioned, which was issued under Sri Lankan law, but in dollar denominations, they have been given three options. They have a choice. One option is you call it a haircut. That means if you have a bond of $100, you will only be paid $70, which we have a small piece of paper saying you will be paid $100 uh, at the interest rate. They have mentioned an interest rate. So when you go with this bond at the end of that maturity period, you will not be paid $70, $100. You will only be paid $70, and the
Right.
interest rate will also be calculated for that $70.
70. Okay.
Yes, that's one option. That's called a 30% haircut. They have given a second option that is no haircut. That means when you go with the 70, 100 rupee bond, you will get $100, but 15-year maturity with a 9 years grace period. That means for the first 9 years, I think they are not going to pay the interest. After that, the maturity will be after 15 years. So from 2023, if they do it, it would be in 2048.
Yeah.
2023, 2033, sorry,
30.
2038.
38. Yeah.
2038 will be the maturity. And the interest rate, they have brought it down for 1.5%. That's option two. Option three is no haircut, no interest cut, but you can go with the $100 bond, but you will not be paid in dollars, you will only be paid in rupees.
Right.
But again, a 10-year maturity, which is in 2033. So those are the three options given. So whoever the SLDB bondholders can take one of those options according to the central bank guideline. I think the next step would be this will be discussed at the parliamentary uh, oversight committee, and then it has to be approved by the parliament, because parliament has the authoritative power on all matters regarding to public money. Sorry, Akhil, it was a long answer.
No, no,
I had
that's
to
completely
explain
fine because
to make
yes,
sure that I understood it right.
yeah, no, because, exactly, because I think a lot of people had confused with what local debt restructuring or debt restructuring as a whole was, and confused it with what some call a liquidity crunch with the banking sector. Because a common question I believe that was floated around when the idea of debt restructuring was thrown into the pot was whether whether it's going to affect their deposits, whether people, like in the cases of I believe Lebanon, where individuals couldn't, withdraw their savings, and the banks had freezes on their assets. And I think it's safe to assume that that's not a situation that we are likely looking forward at. And you know if if we can go ahead with the debt restructuring, that we are looking forward to, or in some capacity meeting the expectations of the IMF, the initial tranche that was given, right?
Yes, Akhila. Basically, the my view is my concern also. I'm not sure whether this would be in a way adequate to meet the IMF
Right.
targets. I think they have the central bank has said it is adequate. Basically, they have also
Okay.
done a calculation. If you go through that, I think those who can go through that presentation, they have said one option is we only do a external debt restructuring.
Right.
According to that scenario, they have said we cannot meet the target because our gross financing needs or like the money that we need to pay to service the debt, we cannot manage it. The
Okay.
other option is the domestic debt and the local debt, both optimization or restructuring. For that, they have said, okay, we can bring down the gross financing needs has to be about 13% according to the IMF
Right.
target
Okay.
is 13% that they have said it. But and also they need about a 17 billion US dollar relief in terms of debt servicing. So they have said that
Okay.
can be achieved. But the caution here is, Akila, they have said
Right.
that can be achieved, but we are yet to see the working of it because we really do not know how they work the numbers out. I hope it has been done. Of course, the central bank has the capacity, but we want to. It would be we will be very confident to see. Okay, this is the how the numbers have been done, and that's how we show that it's only 12.7% gross financing need that we are hitting the target. So as the
Okay.
17 billion debt relief that we are getting. So that we are yet to see. But my concern is, what if, I mean, I feel this may not be adequate to reach there. So the
Okay.
consequences is then in that case, we have to have a go through another debt restructuring if we realize after it
Once again.
won't happen immediately, but after 4 to 5 years when we move on this process, if we realize that, okay, this is not enough, again we have to do a debt restructuring. But having said that, Akila, there is no, in my humble view, there is no right or wrong answer in this. Right or wrong answer in the sense, the best option is not to go for a debt restructuring and run a proper economy. So then you need not to have this conversation in the first place.
Okay.
But that phase has passed now. We of course mismanaged the
Yeah.
economy. Now we have to come to the debt restructuring phase. And when it's come to the debt restructuring, of course there will be only losers. There will be no gains to anyone. So I was, in my view, I mean, we have to. It's like a surgery. When you are doing a surgery, or it's like an engine repair in a vehicle. When you are doing an engine repair, you are not taking a risk on like a small wheel or something because you can't, unassemble the vehicle like the engine every weekend. No. You have to do it like once and for all, and then you should be able to run it for a longer period of time. Like a surgery, you can't do the surgery this weekend, another heart surgery next weekend. When you are doing a heart surgery, you better get it done properly
Right.
once and for all, so then you are functioning well for a significant time period. So I'm not sure if this is adequate. Then the risk is that we have to go for multiple restructurings,
Right.
and the research has shown that when a country is going through the first debt restructuring, they have to, on average, they have to go through like two average debt restructuring. I think for country to country it depends. But I would prefer to avoid any further debt restructuring. You do it once and for all and move
Right.
forward. But the question is, if you are not for EPF and ETF, if you are moving to the banking sector, one can question, okay, are you advocating to add more stress on the banks and have a problem in the banking sector? Of course, I can't advocate for that as well. So it's a there is no right or wrong answer. If you're saying, okay,
Right.
not with the EPF, ETF, with the banks, then the banking sector will have questions. But I felt there could have been a better restructuring, in my humble view, where we will not have the need to go for a better restructuring because our target is we are trying to bring the debt to GDP ratio for 95%.
Yeah.
At the moment, it's 128%. 95% is also, Akila, a very high number. Ideally, we
Yeah.
should
It
come
is.
to, there is no magic number, but ideally we should range between 60% to 70%. So
Right.
95% in 2032. That is 10 years, you are just at 95%. So pretty much people's lifespan has been passed. Only the new generation has to bear that. So I
Right.
prefer that, okay, we do it since we mismanaged, since we all were responsible as a
Okay.
generation, let's get it in once and move forward. But I think it seems that it hasn't been the case. But also we have to wait and see whether the presentation that we are referring is the same presentation that has been put forward to the parliament, because that
Right.
also has to be checked. Because the
Yeah.
cabinet paper we couldn't find it yet, so we have to really see on the cabinet paper. That would be my overall thought, Akila, on the restructuring.
Right, Dana. Thank you so much. I think you've covered everything that I could possibly ask, and with the information that we currently have, because a lot of it is kept under the rugs, if I'm not mistaken, at least until Saturday, when Parliament can meet and the COPE can meet and decide as to how we're going to proceed with this. So, just to our audience out there, we're always open for questions. Speaking of Dana, we do have one. Tilanga has asked us. If bond interest is reduced, will that affect the fixed deposit rates of existing deposits?
Come up again, Akila.
Right. So the question was, if bond interest rates are reduced, will that affect fixed deposit rates of existing deposits?
Actually, now, according to the restructuring plan announced, if they are going to go ahead with this one, the bonds which is holding by the banks, that those rates won't come down.
Yeah.
So then interest rates cannot affect, but actually the interest rates may come down, not because of anything else. Basically, because of when the suspicion on domestic debt restructuring is over, the interest rates will automatically come down. One reason why the central bank interest rate, the guidance interest rate of SLDR and SLFR, where the actually the market rate is quite higher, because people are, or the banks are concerned what would be the repercussion on the domestic debt restructuring. So
Right.
once this was cleared, actually the interest rates will come down. So actually the deposit interest rates and the lending interest rates will come down. But it doesn't mean that if you have a fixed deposit which has committed for 5 years on that particular interest rate, it doesn't mean that will come down, or two
Yeah.
years
Right.
that won't come down. But overall, when you're going with money to start like a to begin a new fixed deposit, that interest rate will come down. At the same time, the interest rate when you are going for a housing loan or a vehicle loan or a business development loan, that interest rate will also come down. It is overall market interest rate ideally should come down if the suspicion, or like if the clarity was made on the debt restructuring process. It doesn't mean that the if you have a fixed deposit or some fixed some way of saving, those
Right.
rates will come down. And according to this plan, even the bank treasury bonds that they are holding, those interest rates cannot come down, because it is the banking sector has kept completely aside of the restructuring. And I think one reason why they have maybe kept aside the banking side, the government has, or the central bank has provided three main reasons. First reason is
Okay.
already their profitability has been affected because of the non-performing loans.
Right.
Non-performing loans means if Akhila and I take a loan from the bank, if you are not servicing the loan, that means the depositor's money have been in risk. So the non-performing loan ratio has been increasing to about 13% from about 8%. That is a big number in that sense. So as a result, that's one reason. And also there have been multiple moratorium packages being provided from COVID for economic crisis. So that
Right.
one reason that the banking sector has severe stress. And also they have said the banking sector, the taxes has also been increased, because earlier they were supposed to pay 24% tax. Now with the new tax revision, they have to pay 30% corporate tax. And of course, there was VAT on financial services earlier at 15%, and now it is at 18%. So overall, about 48% taxes has to be paid by the banks, opposed to 39% earlier. So because of the taxes and because of the non-performing loan ratio, and of course the moratoriums that they have given, that was another reason. And also the banks anyway have to take some cut or like a hit with the restructuring with the SLDBs, because Sri Lanka development bonds, a
Right.
significant portion being kept by the banking sector, and some banks are even holding the international sovereign bonds. So when we restructure,
Okay.
that burden has to be borne by the banks. That may be one reason why they have considered. And at the same time, in terms of banks' income, about I think about 36%, according to a research paper done by Verite, about 36% of banks, all banks' net interest income is based on government securities, that is treasury bills and treasury bonds,
Right.
mainly the treasury bonds. So that may be one reason why they have been concerned to restructure the government sector. Those are the insights that I have, Akhil, on answering that question.
Right. So I guess indirectly the banks are put under a bit of stress if there's going to be restructuring in terms of how the bonds and the T-bills are working, if a large percentage of their income is based on that. So I guess, and just to add on to what you said, Nanath, regardless of the local debt restructuring processes, interest rates were, as we saw, coming down from the increment that we saw
Correct.
earlier. Because initially, I believe there was a 10%, 1,000 BPS, and then another uh, 950, if I'm not mistaken, increase in the deposit and the borrowing rates as well, lending rates as well. And it's slowly coming down because I think it's infeasible to have interest rates so high, especially when you're going through such economic crises. So, Dharnath, I think we have covered everything that we could have, especially with the little information that is available to us. Because a lot of people have been quite confused, or the lack of information, I believe, uh, that was withheld from the public in order to maintain stability, also created a little bit of fear and doubt within, I guess, certain sectors of society as well. And a lot of people were confused as to how it would affect their livelihoods, right? Because it's all well and good when we talk about local debt restructuring, if at the end of the day people aren't aware how it's going to affect their day-to-day lives. So I think from what we can gather on at the time being is that EPF, ETF, the superannuation funds won't have much of a issue when it comes to people claiming their payouts at the end of their term or whenever they want to. Um, Mostly, it'll be affected on SLDBs, or in other words, foreign currency bonds that have been issued by the government, and treasury bills that are held by commercial banks will not be affected, and it will be most likely the central bank in itself that has taken part in the primary dealings in the treasury, in the primary market, that will have to take a bit of a haircut or some sort of coupon rate cut in that situation. Right. We have one more question, Dana, before we wrap up. Is that now, if foreign investors, in the terms of ISBs, are moving out of the security markets, and they're moving more into assets in terms of the exchange rates, what are the implications for the foreign investor?
Uh, in The implications mean it we have to wait till the I mean if it's on the existing bonds that they have already bought, the international sovereign bonds. So we have to wait and see what is the exact plan that the government plans to move forward. Of course they can sell the sovereign bonds, even these restructured bonds they can sell it at the secondary market and move out from the market. That is perfectly fine. I think that's what they do. Like when the markets are functioning well, when the rates are going up, they basically trade these bonds every time, every day, like the stock market. People buy stocks, people sell stocks. Likewise, they can do that. Of course, but if there's a negative, I mean, if people are scared, if they want to really give on the secondary market, if they want to sell the bonds and leave, that will not indicate positively on the Sri Lankan context. That may be something to consider. Also, Akhil, I wanted
Right.
to add quick two points on the EPF and the ETF. I think
Sure.
uh, the impact on the EPF ETF. I think we spoke this before as well. In my view, as I have mentioned before, already the all funds, everyone's asset, including EPF, ETF, has restructured through inflation.
Right.
Because on inflation, when inflation goes to 50%, 60%, that's the central bank given rate. But in my view, it is more than that, depending on person's consumption pattern. So already it is restructured because now from the EPF, what we could have bought from 5 years ago from the money. I think the money value is there like 1 million or
Right.
2 million or 300,000, but the quantity of goods that we can buy is pretty much half or even less than half. So it's restructured on one sense. On the
Right.
other hand, what is the real loss for the EPF would be they are promising 9%, but actually the up to now the bond rates, the existing bond rates are quite higher. So basically
Yeah.
it's called like, there is an opportunity if there was no restructuring on EPF in a very good case scenario, the best case scenario, they could have earned an additional profit if they can,
Yes.
if the interest rates are more than 9%, if they're offering, EPF could have had a better interest rate. Also, that can be trickled down to all the EPF, ETF members. So that's what basically the loss for the EPF would be. I think the government and the central bank should really show like what is the percentage out of 2.5 trillion,
Right.
what is the expected like foregone estimation of EPF, ETF funds because of this interest rate.
Right.
It is not like losing. It's like the same argument that we have put forward for some of the state-owned enterprises. Some of the state-owned
Right.
enterprises, they are a monopoly. They say they are making a profit, but actually the private sector could have
Much
made
more.
more profits than what is the government sector that one monopoly institute is making if under the
Right.
competitive environment. So that's one can say the state-owned enterprise is making profit. That is true, but actual profit that they could have made was much higher than that. So likewise, the EPF is making 9%. They have promised 9%, but they could have made more without this debt restructuring, in my view. That's number one. Other thing is also we have to understand this EPF fund has been mismanaged over a period of time because we know it was misused by investing in some stock market and something, and then on the bond scam, and now this. So we all know 2.5 trillion rupees is quite a sizable amount where you need solid professionals, good fund managers with proper incentive schemes to manage this sort of fund, because otherwise it definitely is going to misuse because people really do not have a sense on what needs to be done. In otherwise, people should be given that option to invest their own money on better channels. But of course, we know that is also difficult because people really do not know, they don't have the financial literacy. But if they were given the choice, I'm sure they would have invested in better choices where that they will get better returns. But given that
Right.
you have this 2.5 trillion, almost about 3 trillion massive fund, which the government is using for all sorts of things without a proper foresight, and this has been misused over a period of time. And this unfortunately became the reason. I mean, misused in the sense it's not like a loss, real loss, but the profits could have been much higher if it
Right.
was
Right.
invested properly. So those are the three things that I want to add uh,
Sure.
on this conversation, Akhila.
Okay, all right. Thank you so much, Dhananath, for joining me today and helping a lot of us understand. At least I was personally quite lost, when it came to understanding what was exactly going on, because there's a lot of information being thrown around, like I said, because of a lack of information. So, just to our audience, we would like to say thank you for joining us today. We hope we help you understand the situation better, and hope this information we're giving to you will be better. Usable in your day-to-day activities, and you can understand and how to make a rational choice when it comes to decisions that you have to make. So for more information on domestic debt optimization in the following coming weeks, because that's something that will keep on carrying on, which will be a national conversation, if I'm to say so. Social media platforms, Advocata Institute for in English medium, Advocata Plus in Sinhala, and Advocata Kural for the Tamil language. uh, so, Danath, once again, thank you so much for joining us. And thank you to our audience for listening to us. And hope you have a good day.
If you are interested in seeing more content like this, don't forget to like, subscribe, and follow Advocata on all social media platforms to never miss out on our latest content. Consider supporting Advocata by becoming an individual subscriber. Gain access to our weekday media monitoring of economic news, exclusive Advocata events, and more. To learn more, visit us at support.advocata.org.